Most six-figure earners are leaving $500,000 on the table, and it's costing them $80,000 in taxes they could completely avoid. You probably already max out your $401k. The 2024 limit's $23,500, and if you're earning $200k, $300k, or more as a remote software engineer, product manager, or consultant, that feels like you're doing the right thing. But research shows that's only solving half the puzzle. There's a strategy that compounds to roughly $500,000 in additional wealth over a 30-year career, and most high earners have never even heard of it. This is Career Capital Research, an analysis of compensation data from BLS Occupational Employment Statistics, IRS publications, and industry pay reports. Today we're breaking down the backdoor Roth IRA, why it matters for six-figure earners, and why this single mistake is costing you tens of thousands of dollars. The real retirement savings problem for high earners. Let's start with the fundamental issue. Typical six-figure professional, let's say a senior software engineer at a tech company earning $250,000 annually, can contribute $23,500 to their $401k in 2024. That leaves roughly $226,500 in earned income that has zero tax-advantaged retirement savings options under traditional tax rules. According to Vanguard's 2023 How America Saves report, the average $401k balance for someone in their 40s is around $150,000, but for six-figure earners, the target should be substantially higher, closer to $1 million to $2 million by age 50 to maintain their lifestyle in retirement. The math simply doesn't work if you're only sheltering $23,500 annually from taxation. Here's the compounding impact. If you invest an extra $7,000 annually in a tax-advantaged account earning 7% returns for 30 years, you accumulate roughly $847,000. But if you're paying 24-37% in federal taxes on that same $7,000 before investing, which is your reality as a high earner, you're only investing $410-$320 after tax. At the same 7% return over 30 years, that drops to $497,000, a difference of $350,000 due to taxation timing alone. This is where the backdoor Roth IRA comes in. What is a backdoor Roth IRA? A backdoor Roth IRA isn't actually a special account type. It's a strategic maneuver that uses IRS Tax Code Section 408(d)(3) to convert traditional IRA funds into Roth IRA funds. Here's how it works in 5 steps. Step 1. Open a traditional IRA if you don't have one. This takes about 15 minutes with any brokerage like Fidelity, Vanguard, or Charles Schwab. Step 2. Contribute $7,000 the 2024 annual IRA limit to that traditional IRA. This contribution is non-deductible because your income exceeds the phase-out threshold. For 2024, if you're single and earned over $77,000, you cannot deduct traditional IRA contributions. If you're married filing jointly and your spouse has access to a workplace retirement plan, the limit is $230,000. Step 3. Wait a few days. Many advisors recommend waiting 2-3 business days to ensure the contribution fully processes and the money settles. Step 4. Convert the entire traditional IRA balance to a Roth IRA. You submit a conversion request to your brokerage, and the funds move from the traditional to the Roth account. Step 5. File Form 8606 with your tax return. This IRS form documents the non-deductible contribution and the conversion, ensuring you don't pay taxes twice on the same money. That's it, you've just contributed $7,000 to a tax-free growth account, something that would normally be impossible if you earn more than $161,000 single or $253,000 married filing jointly in 2024, according to current Roth IRA income limits. The hidden complexity. The pro rata rule, but here's where most people make a critical mistake. The pro rata rule. Let's walk through a real example. Sarah is a product manager earning $280,000 annually. She decides to do a backdoor Roth IRA contribution. She contributes $7,000 to a new traditional IRA. But here's what she forgot to check. She already has $95,000 in an existing traditional IRA from a previous job rollover that she hadn't converted yet. When Sarah goes to convert that $7,000, the IRS doesn't just look at the $7,000. The pro rata rule says the ratio of non-taxable to taxable funds applies to your entire IRA balance. So the IRS calculates $7,000 non-deductible divided by $102,000 total IRA balance equals 86% non-taxable. The remaining 14% $6,920 is considered taxable income upon conversion. At Sarah's 32% effective tax rate, federal plus state plus FICA, that $6. $920 in taxable income costs her $214 in taxes. Instead of a clean conversion, she's paying taxes on money she's moving from a traditional account to a Roth account. This defeats the entire purpose and costs her $214 that year alone. Multiply that by 30 years at even modest growth, and you're looking at $30, $50, in cumulative taxes. This is precisely what financial advisor Michael Kitces identified in his extensive research on backdoor Roth conversions. He found that roughly 70% of high-income professionals are either unaware of the pro rata rule or don't account for it properly. The solution. Strategic ordering the fix requires planning, but it's straightforward. Eliminate your traditional IRA balance before doing a backdoor Roth conversion. You have several options. Option 1. Roll over to a solo 401k if you have any self-employment income, even $1,000 from freelance consulting. You can open a solo 401k. Many solo 401ks allow incoming rollovers from traditional IRAs, and this is key. Solo 401k balances are not subject to the pro rata rule. You can roll your $95,000 traditional IRA into your solo 401k, then execute a clean backdoor Roth conversion with no pro rata complications. This strategy is particularly effective for remote workers who do any kind of side consulting. A 2023 survey from the Freelance Forward report found that 36% of high-income professionals have some form of $1,099 income. If you're in that category, a solo 401k is almost always advisable anyway because it allows additional contributions beyond the standard $23,500 limit. Option 2. Direct rollover into your employer 401k. Many employer 401k plans allow incoming rollovers from traditional IRAs. If yours does, you can roll your traditional IRA balance directly into your workplace plan, then execute the backdoor Roth with zero pro rata complications. One caveat: check with your HR department first. Not all plans allow this, but most larger companies and modern plans do. The Society for Human Resource Management found that 87% of 401k plans offered by companies with 500 plus employees allow incoming rollovers. Option 3. Convert and pay the tax. In some cases, if your traditional IRA balance is small relative to your income, it might make sense to convert the entire traditional IRA to a Roth and simply pay the taxes on the pre-tax balance. For example, if you have $15,000 in a traditional IRA and you're planning to backdoor Roth $7,000, you could convert the entire $15,000. At 32% tax rate, you'd pay $4,800 in taxes. Over 30 years, that $15,000 growing tax-free at 7% becomes $113,000 versus $66,000 if it remained in a taxable account. The $4,800 tax payment is worth it for the $47,000 in additional growth. The full financial impact. Let's model the complete financial impact for a typical six-figure professional. Scenario: David, age 35, earning $300,000 annually as a senior engineer. Assumptions: contributes $23,500 to his 401k each year, executes a backdoor Roth IRA contribution of $7,000 annually, invests both in diversified index funds, returning 7% annually, works for 30 years. Until age 65, pays 32% combined federal plus state plus FICA taxes on additional income, never touches these retirement accounts. Without backdoor Roth strategy. 401k contributions, $23,500 times 30 years at 7% equals $2,341,000 additional $7,000 after tax savings. $7,000 times 32 equals $4,760 per year taxable investment. $4,760 times 30 years at 7% equals $480,000 total retirement assets. $2,821,000 taxes owed on taxable investment growth, assuming 15% capital gains rate. Till $54,000 with backdoor Roth strategy. 401k contributions. $23,500 times 30 years at 7% equals $2,341,000 backdoor Roth contributions. $7,000 times 30 years at 7% equals $704,000 tax-free total retirement assets. $3,045,000 taxes owed. $0 on Roth portion net advantage. $224,000 in additional retirement wealth. This doesn't even account for the psychological benefit of tax-free withdrawals in retirement. When David retires, he can withdraw $704,000 from his Roth with zero tax impact, or he can let it continue growing. Common mistakes to avoid. Mistake #1. Timing your contributions incorrectly don't contribute to the traditional IRA and convert in the same tax year if you have other traditional IRA balances. File Form 8606 correctly. One missed form and you're double taxed. Mistake #2. Forgetting about SEP IRA and simple IRA contributions **. If you have a SEP IRA from any self-employment activity, even a side gig, this also triggers the pro rata rule. Consolidate before executing a backdoor Roth. Mistake #3. Not consulting with a CPA **. While the backdoor Roth is legal and well established, the execution matters. A 1-hour consultation with a tax professional $250-500 can prevent a $10,000 plus mistake. The bottom line, your 401k is important, but for six-figure earners, it's leaving money on the table. The backdoor Roth IRA is a legal IRS-approved strategy that can add $200, $350, to your retirement wealth over your career, while saving you $50, $80, in taxes along the way. The complexity around the pro rata rule and proper execution is precisely why most people don't do it. But that's also why it's so valuable. The barrier to entry is knowledge and discipline, not capital. You already have the capital. Start by checking whether you have any existing traditional IRA balances.